President Trump's One Big Beautiful Bill Act. A lot of talk about it in the news. Everyone's been going crazy. I'm here to talk to you all about what this means for real estate and the impacts on real estate. Our National Association of Realtors put out a press release, and I want to go over some of the pointers here for you that I think affect buyers, sellers, existing homeowners, future buyers, etc. Number one, a permanent extension of lower individual tax rates. Well, remember, in 2017, with the first Trump tax bill, they cut down many of the tax rates, okay? They brought them down by a couple of points. The highest rate of 39 went to 37. The 25% rate went to 23 or 22. Now what they did is they made those permanent. In addition to that, and it doesn't say it here, but I wanted to point it out, the corporate tax rate is going to remain at the lower rate that got enacted in 2017, which is very, very important for business, and it's important also for the United States to be competitive in the world. But staying on real estate. Number two, a permanent qualified business income deduction, Section 199. So there's a lot of talk about things that are able to be deducted. And there's also been a lot of videos and a lot of talk about how there might be a rush on Airbnbs and rental properties. Well, that is because this bill enables purchasers of trucks, of equipment, and also houses to write off the cost of the asset year one. Normally, things are depreciated over 5 years, 10 years, 20 years, 39 years for other things, commercial real estate, residential. I'm not an accountant. Don't quote me on the numbers, but something like that. Well, now they are allowing immediate depreciation in the first year. This is going to enable large income people with large incomes and companies with large incomes to purchase things and write them off the first year, and it takes effect this year. So I believe the purchasing of assets will increase again. And remember, it's been on the downslide for 3 or 4 years now, really about 3 years, since interest rates went up. When interest rates go up, less and less things are purchased. That's what we've been seeing. So they clearly made this effective in 2025 in order to get a rush out of people into buying things. I thought that was interesting. Number three, a temporary 5-year quadrupling of the state and local tax deduction cap. That's SALT. Now, this is something that really became a thing in 2017. When they made the tax cuts back in 17, they had cut the corporate tax rate, they had cut the individual tax rates, as I had just explained, but in Washington, if there's give, there's get, right? When one side of the aisle wants to get, they have to give something. Well, one of the negotiation points became a homeowner's ability to write off their state and local tax bills. So when you pay property taxes, well, they capped it at $10,000. So if you live in an area like I do, close to Boston, and if you have a tax bill on your property that is north of $10,000 a year, like I do, and like many, many people do close to Boston, close to LA, New York City, right on the coasts with the higher prices, you're not allowed to write off anything over $10,000. So you're only allowed to write off the $10,000. Well, they fixed that in this bill. Now you are allowed to write off up to $40,000. They quadrupled it. So for those of you with tax bills that are $20,000 a year, $25,000, $30,000, whatever it may be, that live in higher price markets, you can now get a tax deduction for your property taxes up to $40,000. Number four, protection for business SALT deductions and 1031 like-kind exchanges. I just talked about SALT. I'm going to focus on 1031 like-kind exchanges. So the reason they put that in there, and the reason the chief lobbyist at the National Association, Shannon McGann, made sure to make note of that, is they protected the 1031 exchange. The Biden administration had talked a lot about getting rid of the 1031 exchange. And remember, the 1031 exchange enables you to sell a property, take the profit, and put it into another property, typically a larger property, so long as you do it within 45 or 90 days if you get an extension. There was discussion of eliminating that and making it so that investors and people had to, if they sold a property, they had to pay tax, and then what was left, they could use it to purchase something. This 1031 like-kind exchange has been around for years, and it has been protected. So that is safe. Number five, here's something else that was extended. I thought the wording was interesting. They said a permanent extension of the mortgage interest deduction. So almost every single time there is a tax bill in Washington for the last 40 years. Lawmakers, sometimes on the Republican side, sometimes on the Democrat side, say, we want to decrease the mortgage interest deduction. Folks, this is arguably the most important piece of tax legislation related to housing in 200 years. Okay, the ability to write off the interest that you pay and expense it in your taxes so that you pay less taxes is paramount. It's so important. It's so important to housing, and the National Association of Realtors puts a ton of focus on protecting that. I distinctly remember tax bills back in the early part of the century where there was discussion of decreasing that, and they fought tooth and nail to make sure that stuck. So that has stuck, but I find it interesting that they didn't say it was made permanent. There was a permanent extension. So some details there, obviously, but you can know if you're a homeowner, the interest that you pay is protected. And if you are a want-to-be homeowner, someone who is soon to be a homeowner, then you should be excited to know that if you're paying rent now, you can't expense any of that rent in your taxes. But once you are a homeowner and you pay interest on your mortgage, which the first 5 years of the mortgage, you pay a ton of interest, very little principal, you will be able to write that off, and that is why you will pay less taxes once you are a homeowner. In addition to that, there were a couple of other things. Those are the top five. A couple of other things. Permanent improvements to low-income housing tax credits to support affordable housing developments. An increase in the child tax credit of $2,200. I believe that was $2,000. It went up to $2,200. That's a little bit extra money for people. This one I thought was critically important, a permanent $15 million estate and gift tax threshold protecting generational wealth transfer. Have you ever watched Yellowstone? If you've watched Yellowstone, you know that there was great fear and great problems for that family in keeping their property, because when parents died, they couldn't easily pass the property on to their kids without their kids owing a ton of money in estate taxes. And there was a threshold of $5 million. Well, $5 million's been in place a long time, and it's no longer realistic. Property values have gone up a lot, and other, people's assets have gone up a lot in the last 20 years. And people's estates being over $5 million was quite common. That's why they raised it to 15. So if you're someone that owns, it doesn't always have to be a farm either, just someone that has a family member or someone who they're going to be selling a property, or maybe they pass away and you're worried, am I going to get stuck with that tax bill? So long as the total assets threshold is 15 million, then you should be safe. Again, I'm not an accountant. Check with one on details. I'm here to give you an overview. Restoration of critical business provisions, including full expensing for researching and development and bonus depreciation. I touched on depreciation. Immediate expensing for industrial structures, boosting investment in manufacturing, agriculture, and related industries, strengthened opportunity zones, renewing targeted incentives to drive economic development. That's an important one. I've got a friend who's in the real estate development business. He's very knowledgeable on opportunity zones. And in the last couple of years, there has been some hesitation to utilize those opportunity zones because they were worried about deadlines. It sounds like they provided some relief there. There was also an introduction of a baby bond of $1,000 for children born in the United States. So a lot of important things for housing came out of this bill. Could there have been more? Yeah, there's something I wish that was in here. I wish that the capital gains tax exemption got extended. And I shouldn't say extended. I don't mean extended in time. I mean expanded, okay? It's been $250,000 for a single person, $500,000 for a married couple filing jointly for like 30 years. Okay, the average price of a home, take here in Massachusetts, is now over $700,000. When I first got in the business in 2004, it wasn't even $400,000. Okay, so as prices go up, the amount of equity that people have goes up, and that exemption becomes not as much as it should be. Okay, there's many people that have had much larger gains, and that is part of why, it's a small part, but it's part of why many people across the country don't sell their properties. Because they say, well, I'll just hold on to it. I don't want to pay the tax. If the capital gains exemption got expanded, if it was larger, I do feel it would have had a impact on the inventory of homes for sale, and more homes would be listed. But actually, that's happening anyway due to the market. I know the National Association worked towards that happening, but it just wasn't in the cards for this bill, and I'm hoping it happens in future tax bills down the line. I hope that gives you all a better understanding of the One Big Beautiful Bill Act. Obviously, it was a major piece of legislation. There's people on all sides of the aisle. Some love it, some don't. Hard to see what's true, but I wanted to talk to you all specifically about housing, and I hope that makes sense. Good luck. Happy home buying, happy home selling, happy home ownership. Talk to you soon.